At the time of this recording, the average 30-year mortgage rate for a home is in the low 7% range.
Out showing that mortgage rates are once again rising. They have soared back way above 7% now, the highest level since late last year, meaning it's much more expensive to try and buy a home.
And if you have poor credit, the average percentage is around 8%. And that is a huge difference than getting a loan locked in at 3%. The affordability for a home at 8% and 3% is massive. And the quality of home that you can afford is massive. Getting these lower rates will increase the affordability of a primary residence and can be the difference between an investment property cash flowing and not cash flowing. So let's start by talking about Pace Morby. So Pace Morby has done about 7,000 renovations over the past 10 years. He does 150 wholesale deals a year, 50 flips a year, and he owns about $32 million worth of buy and hold real estate. And he's done all of this through creative financing. Pace Morby is the king of creative financing, and he's the one who introduced me to the first two ways that I'm going to share with you to get low interest rates. So subject to is a creative financing method where you can take over someone's home through the deed. So the homeowner has an existing mortgage in place. You go through a title company where you agree to continue making the payments on their mortgage. The deed gets transferred to your name, and then any equity in the home, you can make an agreement with the seller to either do a wraparound where you pay it back to them, or you don't pay the equity back to them at all. And a lot of times these subject to deals are on distressed properties. So they're on properties that the person was going to lose because of foreclosure. It's a property that's in disrepair because the owner doesn't have the funds to upkeep the property, or it's a property that got passed down to someone and they don't have the bandwidth to take care of it. So there's a variety of reasons why people might do these deals, but if you can negotiate a subject to deal with someone who locked in a low interest rate loan, you can actually acquire one of these 2 to 3% interest home loans on a property. The other creative financing way to acquire a property is seller financing. So the biggest difference between seller financing and subject to is that in seller financing, the property owner owns the property outright. And if they own the property outright, then essentially they can act like the bank and you pay that homeowner directly as if they were the bank. You can negotiate all the terms of the loan, including the interest and the duration. And it is possible to negotiate a 0% interest loan and acquire a property.
Oh my God! Wow!
I have seen many testimonials from Pace Morby and some of Pace Morby's students about negotiating 0% loans on seller finance properties.
Deals up. That was a 0 down, 0% interest seller finance deal with a seller. The same exact day, I bought a subject to deal. Same.
And you might be wondering, why on earth would someone give someone a property at 0%? And a lot of times these are people who've owned the home and they had rented it out for years and years and years, and they just want to retire. But they want that continued income stream in retirement. So by selling the property seller finance, they lock in the income from the property across whatever terms they specify in the loan, and it lowers their taxable burden because the income is spread out across many years and isn't a large sum that can be taxed. In this high interest rate environment, a lot of people have found themselves on the sidelines. So there is low competition for real estate at this very moment. And that low competition has created a window where you can actually go negotiate the subject to and seller financing deals. So to go get these subject to and seller financing deals, you're going to have to cast a very wide net. It's going to involve a lot of phone calls and a lot of driving for dollars is what it's called, where you look for distressed properties around you. And I personally don't have the time to actually commit to a dedicated seller finance and subject to search. But these next two strategies I'm going to spell out are the two that I've been using in my house hunt in 2024. So my wife and I have been looking for a primary residence here in Texas, and we are trying to assume someone's mortgage. So unlike subject to and seller financing, assumptions can only be done for properties that have VA loans or FHA loans. And there's actually a platform that lets you see these assumable VA and FHA loans. So if you go to withrome.com, they list all the properties near you that have these VA and FHA loans that you can assume. And whatever equity that person has in the home is what the down payment would be on that home to actually acquire it. So if they bought their home a long time ago and refinanced in 2020 or 2021, then the down payment can be quite high. It can be over $100,000 or more. But if they purchased and they haven't built that much equity to now, the down payments can be really small. So $3,000 to $10,000, whatever equity the person has in that house. The assumption process has the same underwriting requirements of any traditional loan. You're gonna have to bring your pay stubs and any bank statements and investment statements, your previous tax returns, all that paperwork that you would normally require to provide to a lender, you're going to have to bring to this assumption process. So going through this process, trying to convince someone to assume their home has been very difficult. So we had a home under contract and we thought we were on the path to closing on this house, and the person realized that they were going to need to bring money to the deal to close the home. So this is before the NRA lawsuit settlement. The buy side and the sell side real estate agents both get 3%. And that 3% on the buy side and the 3% on the sell side, that 6% total, comes out of the seller's capital. So whatever equity that they have in the house, that's what's going to be funneled towards paying the buyers and the sellers real estate agents. And if you don't have enough equity built up in your house, you actually are going to have to bring money to the closing table to move your house.
Oh, hell no!
And the seller of this home did not realize this. So we had the property under contract, we had done the inspections, we were trying to get a closing date set, and they backed out when they realized they had to bring money to the closing table. Some other things that we've run into trying to do this assumption is that some people are so unfamiliar with how this assumption process works, they assume that we're attempting to scam them, even though we're giving them a full price offer on their home, and they would get all their money like they would get with any other traditional sale. So we approached someone and their home had been sitting for over 60 days. We gave them a full price offer. They would have gotten all their equity, all the money in their home, and they said no because they were so unfamiliar with how the assumption process works.
Why are you running? Why are you running?
And I'm guessing that their real estate agent was not equipped to actually explain that whatever equity in their house they were going to get, and all the paperwork would actually go into my name. So that's one of the biggest differences between an assumption and subject to. When you assume a house, the mortgage actually transfers to the new owner, where when you do subject to, the mortgage stays in the original owner's name and there's just the deed that transfers over. So an assumption, essentially the person is completely divorced from the property. And the other thing about assumptions is that the closing process can take a little longer. So on average, closing on an assumption can take between 40 to 90 days, where a traditional closing is 30 to 60. But with Rome tries to incentivize people to allow an assumption by saying that if it takes more time than we initially allot for, they will actually pay this person's mortgage in the meantime while we wait for the closing to occur. So realistically, if you're going to go one of those 3 creative finance routes, you're going to have to cast a very wide net and give yourself a long timeline. You should expect that this house hunt is going to take between 3 and 8 months to complete.
Ain't nobody got time for that.
And you can't get locked in on any one particular house as your dream house because it's so close to a Chipotle, or it's so close to the movie theater, or has the best school system. You need to be a bit more flexible about what you're putting an offer in on, and you need to cast a wide net and put a lot of offers out there. But if you get one of those accepted using one of those 3 creative finance methods, you're going to save a ton of money each month. So the final way my wife and I have been considering is builder buy downs. So there's a lot of builders who are sitting on a ton of inventory. There are so many potential home buyers who are sitting on the sidelines and aren't purchasing homes, but they are still cranking out this inventory and they want to move it. So there are builders who are buying down your interest rates. So there are some programs that have temporary buy downs. So they'll do what's called a 3-to-1 mortgage. So in the first year, it's a really low percentage, and it goes a little higher than in the second year, a little higher in the third year. And then in year 4, it locks in to a set interest rate. And usually that set interest rate is somewhere around 6%. So that type of mortgage product, you're banking on the fact that in year 4 or year 5, rates are going to come down enough that you can refinance out into something lower. You're assuming that 4 or 5 years, interest rates are going to be in the 3 to 4% range and allow you to refinance down. And then some builders are actually providing a permanent builder buy down. So this is the product that I would advocate for and the one that my wife and I have been looking at. So instead of this tiered interest rate buy down, it's a set level that they buy your interest rate down to. So I've seen 4.99% and I've seen as low as 4.5%, a permanently low fixed interest rate on your property. And this is on a brand new house. So you can get a brand new house at around 4.5% for 30 years. It's not as good as 2%, but you are buying brand new. So you can get all the customizations to your home that you want. These builder buy down programs come with the constraint that you're in a new community. So a lot of these communities have HOAs, they have up and coming school systems, they're being newly established. So you don't necessarily know what that area is going to look like when it's fully formed. But this is a very interesting way to get a low interest rate on a home and buying in an area where expansion is occurring. So you're locking in this low rate on an asset in a location that you know the edge of development is developing into. So hopefully I gave you some ideas on how you can finance your next property at a lower interest rate than you probably thought was possible. And if you're still on the fence about finding real estate in 2024, and if you're wondering if real estate is a sound investment, even if it doesn't cash flow, I actually have a video on why you should be investing in real estate, and cash flow isn't necessarily the biggest reason why. So feel free to check that out, and I will catch you guys next time.